recall in our previous session, we talked about three categories of financial asset. One, we talked about the financial asset at fair value through profit and loss, which basically we said is investment in equity instrument for speculation or trading purpose. Number two, we talked about financial asset at fair value through other comprehensive income, and actually we say that is still investment in shares, but the entity intends to retain the ownership of those shares for a long period of time. And then number three, we talked about financial asset at amortized cost, and actually we say financial asset at amortized cost. This is investment in debt instrument. Investment in debt instrument, for example, investment in debentures, investment in maybe own stock or maybe bonds issued by a company. And as far as the financial asset at amortized cost are concerned, or actually we say for any financial asset to qualify to be classified under the third category, that is financial asset at amortized cost, then we say such a financial asset has to meet two criteria or two tests. One, we talked about something called the business model test, and we say that for any financial asset to pass that test or that criteria, the objective of the company in acquiring such a financial asset or basically investing in such a debt instrument should be to correct or to receive the cash flows associated with such a financial asset. For example, in this case, we say if you invest in government treasury bonds having a life of 2 years, mostly your objective will be to earn interest for 2 years, and then at the end of the second year, once the government redeems those treasury bonds, you're given back your principal amount. So therefore, your objective in making that investment is to correct or to receive cash flows. Number two, we say for a financial asset to qualify to be classified as a financial asset at amortized cost, then we say that the cash flow you are receiving, or actually we say it must pass something called the cash flow characteristic test. The cash flow the investor is receiving basically has to be in interest and the principal amount or the principal repayment. And therefore, if you take on what you're told in this question here, is that this company Ground Limited purchased, or in other terms, it invested in 8% 4 years board. So therefore, this is an investment in a board. Both basically we know is a debt instrument. So this is an investment in debt instrument, and then in the last paragraph we are told the Ground Limited intends to correct the contractual cash flows, which comprises of interest and principal amount. So therefore, you can see this investment in debt instrument basically it passes the two tests. The objective of this company is to correct the cash flows associated with this debt instrument, and number two, it also or the cash flow received by this particular company is in form of interest and principal amount. And therefore, here we can say that this investment in 8%. Is it 8%? Yes, 8% both is a financial asset at amortized cost. Is a financial asset at amortized cost, because it is an investment in debt instrument, and also it passes the two just the business model test and the cash flow characteristic test. And actually we said once you're able to do that, then you need to proceed and determine the amount for initial recognition. And actually this is what we did in the other question, amount for initial recognition. And actually we said the amount for initial recognition, this is the amount at which this particular financial asset was initially supposed to be recorded in the books of account of this company. And